This is the ninth successive increase in interest rates, and when you kind of just compare kind of where we are now with a year ago, that's up by the fastest rate that we've seen since 1989. And that figures, obviously, inflation is the highest rate that we've seen since the 1980s as well. But there is a big jolt happening, which many people around the country are experiencing on top of higher energy costs. And this, I'm afraid, will increase it. If you have a mortgage, especially if it's not a fixed rate mortgage, then you're going to see that rise instantly. If you have a fixed rate mortgage, if you're coming up to refix it, then to some extent this will have already been taken into account. Remember, we were talking a lot of this year about expectations for interest rates. Well, that's already fed into some of those fixed rate mortgage costs. But when you take a step back, look at what's happened recently. We've had inflation potentially peaking, so going down from that high rate and actually dropping a little bit below expectations, still in double digits, but nonetheless going a little bit lower than people expected. You've got the Bank of England slowing the pace of interest rate increases, and obviously that's happening as well on the other side of the Atlantic as well with the Federal Reserve. So you're starting to see things slow down a little bit. And there were some glimmers of hopes within the minutes that were released with this decision. In terms of the decision, by the way, it was a split decision. Everyone pretty much expected that. You've got kind of 9 members of this Monetary Policy Committee which decide on interest rates. 6 of them said, yes, we'll do half a percentage point increase. 2 of them said, no, actually, we want to leave things where they are at 3%. And then one of them actually said we want it even faster than that. Not unexpected, because we're getting to that point now again, as I say, where things are starting potentially to slow down. We're seeing a slowdown in that increase. But the glimmers have also come from the fact that when you look at GDP, so look at the rate of growth in the economy, the bank basically expected it to look a lot worse right now than it actually is. So we're still potentially in a recession right now. It looks very likely, but it may not be quite as deep as it previously expected. And it's only, I know, a little glimmer, but one has to take what one can get after the year that we've had. In that broad picture, inflation potentially having peaked, interest rates still rising, still causing an impact, particularly if you have a mortgage, but not necessarily going up quite as fast as they previously were, maybe only peaking at about 4.5% next year. This is a slight improvement on the bleakness that things looked, the bleakness of the situation only a few months ago.